All right, so hello everyone, this is Celeste, once again from the New Haven Free Public Library in Ives Square. I'm a LTA, and today we have the honor to have Caroline Wetzel, CFP, CDFA, and the Vice President at Fraction Partners in Shelton. She has a BS from Cornell University and an MBA, as well as an advanced certificate in marketing from the University of Connecticut School of Business. Welcome, Caroline. We are so happy to have you here. This is a series that we're going to be having, and this is the first of financial planning bootcamp. So today is the first part of the series, and I'm gonna give it to you so you can tell us everything about it. Thank you everyone for joining us today.
Thank you, Celeste. It's a pleasure to be with you this afternoon. I thank you, Celeste, New Haven Free Public Library, Ives Squared, for the opportunity to be with you today and share with you really important information that you can use to make thoughtful and intentional decisions today and set yourself up for success over time, not only when it comes to your life, and also with your finances. To support our discussion today, I'm going to begin to share with you now a presentation that I've prepared for our time together. Can you just show me by way of a hand signal that you can see this presentation right now at this time? Excellent, thank you very much. And so what I would love to do as we begin together is give you a little bit of context around who I am to complement Celeste's gracious introduction, provide you an additional detail around our shared vision around this 4-part webinar series, and then dive right into the content of this first instance of the webinars. So by way of introductions, what brings us all together in this moment now, and who is this smiling professional at the other end of this video camera? As Celeste said, my name is Caroline Wetzel. I'm a Vice President, Private Wealth Advisor with Procyon Partners. We are a fiduciary, which is very important even in this moment as we have this information exchange today, because it means everything I'm doing is in your best interest. Now, as we take a step back and what brought me to you today, I am a woman who's gone through lots of professional and personal life changes, which is why financial planning and thinking about our money as life changes is so important. By way of introduction, I'm delighted to share that I've been married to my husband, Scott. You see his friendly face there for over 20 years. And I had been enjoying a fulfilling career as a corporate professional with an international financial services company for many years. And put most simply, in a very short period of time, life did not happen according to any plan that Scott and I had for us as a little family. Put most succinctly, we had many miscarriages. I gained lots of weight, lost lots of weight as part of numbing the pain. And additionally, I was diagnosed with a condition that many of you may have heard about, which is alopecia areata universalis. I lost all my hair. So this is a wig, this is all makeup, because I chose to look like how I used to look before all of this health stuff happened to Scott and me. And I don't know about you, but in our little family, when we looked at each other and we said, what's this all about? We said as a team, it's an opportunity to think differently together. You see, I always had a vision that I love to use my knack for finances, my desire to be helpful, and my passion for doing the right thing to serve other people. So when these things didn't happen according to plan, literally this time of sorrow, gave birth to new professional purpose for me. I became a fiduciary. I became specialized in wealth management. In 2017, I joined a team of professionals, some of whom are in the bottom of the page there. And now every day I'm dedicated to helping clients create financial plans, manage their investments, and make thoughtful decisions around how everything from insurance to debt to all different pieces of their financial picture best serve them over time. The majority of my clients have a few $1 million of investable assets that they entrust to our care. And when I'm not working with clients, I love to do things like this, to provide experiences, learning moments virtually through in this way, and even in person, as you see here, uncovering and discovering together what's on our heads and hearts when it comes to our finances, and how can we be more thoughtful and build the future that we imagine together. So it's with that great joy that I am now co-founder of the Women Owning Their Wealth Collaborative, delighted to share with Celeste, New Haven Public Library, I've Squared, and you this vision around how no matter what life presents you, in the same way we strive to take control over perhaps our physical health, we can also make thoughtful decisions around our financial health. And it's with that vision of financial health that this concept of a financial planning boot camp came about. You see, Celeste and I and New Haven Public Library and I've Squared said, how can we as a team make financial health real and real for as many people as possible? So what we've structured beginning with our time together today is a 4-part webinar series. Each one of these experiences offers you different and complementary information. Today's experience, we're going to focus on the fundamentals. In the same way we think of our body vitals, our blood pressure or our heart rate, what we're trying to do today is do the foundational personal financial considerations that any individual would find important to own their future, own their wealth today, and drive it over time. Next week, we'll focus on developing a financial fitness plan or going into the details a bit more about structuring what a plan may look like for you. Beginning then on May 10th, we'll start with the 3rd part of our series, which focuses on investing, strengthening that financial fitness for the way forward through investing in you. And lastly, our last instance will be focusing on training today over time for a financially healthy retirement. So again, in summary, 4 different weeks, different complementary areas of focus that in aggregate, if you attend all 4, you will have a solid, comprehensive foundation that you can use and share with others around approaching your finances. And at any time, if you want more information on any of the above, reach out to me. I'm always eager to be helpful. With that context, let's get right into today's focus, assessing your financial vitals. So what are we going to do together as a team in the next 45 minutes or so? We're going to do 3 things. First, we're going to define financial health and well-being a little bit more clearly, because let's be honest, finances conjure up a whole bunch of emotions for each of us and a lot of different life experiences. And not very often do we necessarily combine health and finances. So we'll level set that and ensure we're on the same page around what we're talking about. Next, we'll review some common money mistakes that many people make. And after acknowledging what they entail, we'll then offer some strategies for preventing them. That way we can be thoughtful and deliberate if we anticipate those mistakes are going to happen, how we can mitigate them and prevent them from actually happening. And lastly, what we're going to do is I'm going to share with you both some tools and a few numbers that may be relevant and helpful so that you can assess where you are in this moment on your own financial health and well-being journey and how you can proceed forward with a level of confidence and clarity around where you're headed. In light of this agenda, then, let's go right into the detail. When we think about financial health and financial well-being, what comes to mind? Do you think of a particular number? Do you think of wearing particular clothes or enjoying specific vacations somewhere? Well, financial health and financial well-being, as I see it, has to do with having clarity around what you're doing with your money, comfort, and understanding the why behind why you're doing it. Excuse me, I'm getting choked up as I talked about it. Comfort and understanding the why about why you're doing it. Thanks, Celeste.
No worry.
And thirdly, confidence that even in volatile times like what we're experiencing now, you are exerting control where you can to optimize your financial choices and make thoughtful decisions. Because at the end of the day, there are things we can control and those we cannot. So said differently, financial health and well-being, you can see laid out here on this next page. And admittedly, I lifted these 4 dimensions of financial well-being from the Consumer Financial Protection Bureau. This is a part of the government that exists to protect all of us, consumers, from different financial institutions and potentially bad things. So when we think about financial well-being, to complement that clarity, that comfort, and that confidence that Caroline offers you, think of financial well-being firstly over having control, as you see on the left-hand side of the page, knowing what's happening on a day-to-day basis and on a monthly basis when it comes to your money. Having that visibility, that clarity. Second, having the capacity to absorb a financial shock. It happens to all of us, and it will continue happening to all of us. Life will not happen according to plan. That trusty vehicle will need immediate emergency servicing at some point. That refrigerator that was so terrific, now I just learned this past weekend ourselves, will need to be fixed or replaced. There will be different financial shocks that interrupt our regular routine, and our capacity to both acknowledge them and address them and absorb them is the second dimension of financial well-being. The third one has to do with being on track to meet your goals. The vision here is that you are thinking beyond today's budget. Since you have the financial foundational pieces in place, you're able to literally and figuratively keep your head up and think, what's next for me? What is it that I want to do with my future? And what is it that I'm striving to experience, to realize, to enjoy, whether it's independently or with loved ones? And this third component of financial well-being says you are able to identify it, you're able to measure it, and be on track to actually realize it. And the fourth dimension of financial well-being says, given I have the foundation in place, I have the capacity to absorb that shock, I have a vision and a track for my way forward, I get to the point of delight. I have the financial freedom to make choices every day, whenever and however I want, around how I'm choosing to make the most of the lifestyle that I want. And this is why financial well-being is so essential. It's not about the number of digits you have in your bank account. It's not about where you live. It's not about the clothes you wear or the people you hang out with. It's around understanding that clarity of what you're doing with your money, the comfort in how you're doing it and the why, and the confidence that as life doesn't happen according to any plan, you have your priorities in place and you can navigate it with confidence. So as a result of this financial well-being, as you'll see at the bottom of the page, people with the same income, comparable financial experiences, or similar education can experience very different levels of financial well-being because of their ability to navigate these 4 dimensions of financial well-being. So with that context, I'm going to pause and take a sip of my water and just pulse check. Any questions here so far around what we're talking about? This is more than dollars and cents. This is around understanding your why and the power that you have with regard to making decisions around your money. Any questions around financial well-being? All right, seeing none, we will press on together. So now that we've level set what we're talking about, how can we best set ourselves up for success? And here's where I'm getting to our second agenda item. What are some common money mistakes and some helpful strategies for mitigating them or preventing them from happening? And I classified these really into 4 main areas of mistakes. The first one has to do with managing finances. Remember how that first component of well-being had to do with knowing your day-to-day, month-to-month activities? Well, when it comes to our finances, many mistakes that people experience has to do with that managing finance component. And it will look different individual to individual. But here are some of the most frequently cited examples of what it looks like. The first may be spending beyond your means. Now, I completely get it. There are times in our life where we might be spending much less than we earn, times in our lives when we might be spending right at what we're earning, and there might be periods of time where, because things are changing, we might be spending more than what we earn. That is a natural, normal course of action when it comes to our ongoing relationship with our finances. What I'm citing here as a common mistake is getting caught in that unhealthy downward spiral of spending beyond our means for an ongoing period of time. And as a result, then what we are doing is we are limiting our financial choices because we are potentially accruing debt. We are setting ourselves up for less financial success over time. So when we're talking about spending beyond our means, what we're continuously doing is we're saying we need to know how much income is coming in, what is it dependent on, when might it be subject to change, and how are we then using that income in different ways on an ongoing basis. The second way of managing finances looks a little different. It says it's not necessarily spending beyond our means on an ongoing basis. It instead is a mismanagement. It's knowing that there might be some big expenses that come up, but we are underestimating how much they really are. If we said, as an example, when I mentioned earlier, the replacing a car, we know it's inevitable, we've got to replace a car, but it's not just necessarily replacing the car itself. If we replace an older vehicle, we additionally need to buy insurance. So the insurance payments we may have been accustomed to paying on a 10 or 12-year-old vehicle may also additionally be higher, and an incremental additional impact on our day-to-day spend for managing finances as well. And oh, by the way, depending upon what type of vehicle you buy in today's inflationary environment, the gasoline that you are fueling that vehicle might have a different price point in comparison to that older vehicle that might have had a smaller gasoline tank that you are fueling all the time. So the second common money mistake is not having sufficient expectation or misjudging the amount that new expenses will actually erode your purchasing power. And the third example of a common money mistake related to managing finances has to do with the regular review of statements. I like to call it, especially in the spring cleaning season, the annual or regular refresh, review, and purging of the slow leaks. So many of you may have done what even I and my husband and I did during the last 24 plus months, moving to different subscription services. Maybe there were different streaming services, different ways that we enjoyed some of our income Since we weren't taking vacations, we weren't going out and doing it in other ways, we introduced new regular activities. If we aren't taking the time out to regularly look at what are we spending our money on, and does it continue to make sense for us, we are missing the opportunity for those incremental additional savings. Said differently, we're still paying for things that we may no longer need. And so this third element of managing finances invites and encourages us to, whenever and however, on some regular basis, just take a step back. Look at, what are we spending our money on? How much is it costing us? And does it continue to make sense where we are today? And you can do this as regularly as seasonally, doing that spring cleaning example, or in some cases, what I encourage people to do is on a monthly basis, take a little time out and look at your monthly credit card statements and bank statements and just see, how is it all adding up and how can we continue to set ourselves up for success? In light of this first dimension of managing finances, key and fundamental to everything we're talking about here has to do with cash flows, has to do with budgeting. And so when we think about here, what is a helpful strategy for managing this money mistake, it's having some kind of view and vision around what your personal budget is. What your personal budget is effectively a reflection. Income coming into your possession, expenses going out. How are you using the cash flows that are coming into your care? And the more clarity you have around that, the better positioned you are to either continue it because it works and it serves you, or just fine tune it a bit and make some changes. Some people ask me, oh, Caroline, do I have to do one of those complicated spreadsheets or do I have to do an app online? There is no perfect solution for every individual. The right solution for you is a budget that you regularly use to ensure that you spend within your means, to ensure that you are able to anticipate and plan for new and different expenses. The type of budget that enables you to look at your flows and say, is it time maybe to cancel that particular streaming service or subscription or regular plan? So it may be as simple as just looking at your income and expenses on a monthly basis, and it can be as complicated as you would like it to be to better support you in making thoughtful decisions. And I'll give you a little bit more detail around that shortly. So to summarize, the first category of common money mistakes, when we think of it in the realm of financial well-being, has to do with those managing of the day-to-day finances, everything from our actual spend to our anticipation of spend, to the ongoing review, maintenance, and cleaning out of spend so that we're being most effective and efficient with our money. Given that first component of common money mistakes, what's the second? The second is managing and mitigating financial setbacks. Remember that second component of financial well-being, which is that ability to absorb a shock if it happens? We know they're going to happen. So how do we manage for them in advance of them happening? The first component, or the example of what this looks like, might include not having enough emergency savings or emergency funds available. Now, this will look different individual to individual, but in general, I recommend that every individual, every working professional, every adult have between 3 and 6 months of your day-to-day expenses in some kind of account that's readily accessible. This may be your savings account. This may be your checking account. This may be in an account where you buy into a money market fund or a CD that you can move out of. The point is that when things like, as I mentioned earlier, your refrigerator breaks or your car needs that additional repair that you hadn't planned for, you have the ability to tap into some cash if you need to help cover that temporary setback. And even in this moment, if you don't necessarily have all 3 to 6 months available, no problem. What I invite and encourage you to do is first know how much do you have, and then secondly, invite and challenge yourself to begin to build that up incrementally, week by week, month by month. As part of managing your finances, that first element, you're watching your cash flows and your budget. So the first element of mitigating financial setbacks is anticipate and know that you need to have an emergency savings account or emergency funds. In general, the rule of thumb is 3 to 6 months of savings. And some people will say to of expenses. And some people say to me, hey, Carolyn, how do I determine which amount? Is it 3 months? Is it 6 months? I'd say there are a couple of factors to keep in mind. First, who are you financially responsible for? Is it only you? Or do you have either children, a partner, or an aging parent that are part of that emergency savings you might need to be helpful with? If it's more than just you, more months may be needed. Second, is your financial success connected to and supported by the income from anyone else? So for example, 2 individuals who are part of a relationship where you share finances, if both of you have regular streams of income, perhaps fewer months collectively together are needed because you have a regular stream of income together. You may have 3 months, your partner may have 3 months, so collectively as a team, you may have 6 months, rather than you having 6 months, your partner having 6 months, and together you having a year. So there are some variables to consider when determining how much emergency funds are necessary. The key takeaway is that you have them and that there is a little bit more there than just the immediate need. To complement this first example, another common example has to do with an inconsistent debt management strategy or payoff plan. Now, I am a fiduciary who does not view debt as a nasty 4-letter word. It's not. It is a strategic tool that, used correctly, open up your financial choices rather than limiting them. It is through debt, for instance, and the careful taking on of debt, that education is possible through student loans. It is the careful identification and assumption of debt that makes things like mortgages and purchasing our homes possible. What I'm talking about here is taking on debt that we don't have an understanding of either how much we're taking on, what the interest rate we're paying on it entails, and a systematic way of getting rid of it is in place. Because it's the getting rid of the debt over time that is important to have in place. So important here to keep in mind, debt is a strategic tool in your toolkit of financial management options. But what's important to consider is to know how much you're taking on, what the interest rate is, and having a payoff plan for reducing it down to 0. And as a general side note, one thing I do strongly recommend is paying off your credit card bills monthly, because what you're doing is firstly avoiding what is often the case, which is very high interest rates associated with credit cards. And additionally, you are increasing your credit worthiness over time. You see, your credit rating is calculated based on many different variables, including, first, how much credit is available to you. Second, what portion of that available credit you actually use. And third, how much of it you pay off and with what regularity over time. So that's why part of the debt management strategy, when using credit cards, I strongly encourage paying them off each month, because not only are you following a debt management strategy and payoff plan that's consistent, but you're continuing to build up your credit worthiness over time. And lastly, in terms of mitigating financial setbacks, here is something that I often find with many people. They may be very, very good about knowing their budget or understanding and building those emergency savings and having a plan for managing their debt, but they don't necessarily understand all that's available to them through their work. So depending upon the style of work that you enjoy today, whether you're an employee of an organization, whether you're a contractor, understand the details around what you are entitled to as part of your employment. So by way of example, in addition to your salary, available to you might be things like disability coverage, health insurance, employer retirement plans that may include matching your contribution. Separate from your specific employment, let's say you're an independent professional or a self-employed individual or a business owner, understand the different types of insurance choices you have chosen to purchase today and over time, and whether, and if so, how they're subject to change. So by way of example, many people may consider once they purchase their first home, and often when they have children, they may consider purchasing life insurance. The vision for that is if something should happen to them, then those who survive them will have access through the life insurance proceeds, should they pass, to have then cash available to do things like reduce the mortgage or have cash available to help with college, etc. What's interesting to note here is, as life gets busy, and as those people who purchase life insurance, say in their 30s, age into their 40s and 50s, and those kids go on to college, those insurance policies may not necessarily have the same need or impact as we age. Maybe new or different policies become important, like moving from an employee of an organization where they give you disability insurance to now being a gig worker, owning your own business in your 50s and 60s, and now you should pay out of pocket some disability insurance coverage because you don't have that through your employer. Or some people in their 50s and 60s realize either they haven't had children or they don't want to be dependent on their children. So life insurance is no longer a priority, but long-term care insurance may be relevant. The key here being, as part of mitigating financial setbacks, this category of money mistakes, we are trying to understand what are the different policies and protections in place that enable a consistency and a quality of life when life doesn't happen according to plan. We want to know if we are employed by an organization or have professional benefits, what they include. And even if we're not employed by an organization, we want to know the role that insurance plays in our financial picture and strategically use insurance to best protect us when life doesn't happen according to plan. So what is the helpful strategy that kind of brings all of this together in terms of mitigating financial setbacks? This has to do with maintaining a balance sheet. Different from a budget, which is the first category of common money mistakes, mitigating financial setbacks says, what is the snapshot picture of what I own and what I owe, and how do these all work together? And so a balance sheet gives you that snapshot view of all of it and enables you to be able to track and understand how much do you have in that emergency fund, how are you managing those debts over time, and what are the other additional benefits you have available to you to protect you when life doesn't happen according to plan. I'm going to pause for another sip of water as we continue through money mistakes. The third category of money mistakes has to do with staying on track. Now, you may recall that the third element of financial well-being had to do with tracking goals and being able to have goals and thinking beyond today's budget. So when we talk about common money mistakes, they have to do with staying on track. What do they look like? The first is the short-term outlook. And this is what I find so many accomplished professionals having. You are so cued into today's needs. I've got my income and expenses covered, Carolyn. I have some investments already set up. Things are doing okay. That's great. And I'm happy that they are. What I need you to realize is on average, men are living until they're 82. Women on average are living until they're 86, which means that the majority of us here on today's experience are very likely to live till that age or even into our 90s. And what we are now experiencing and anticipating is the largest group of centurions, people in their hundreds, than ever before. So even if today is in great shape, we need you to be thinking beyond today and aware of your different choices of how you're managing today's finances so that you are able to continue to enjoy a sustainable lifestyle in your 70s, 80s, and 90s as well. As part of that, what is essential to do is to take a step back and to continuously assess, what are my needs, what are my wants, and what are my wishes? Because let's be honest, there is no shortage of requests of your time and of your money, especially if there are people in addition to yourself for whom you are financially responsible. So how do you manage this continuous, ongoing set of expectations and requests of your money when everything seems to be important? You have to set priorities. And I'm going to give you a little story that I love to share around priorities. I'm the daughter of 2 teachers. My father is a retired community college professor. My mom is a retired high school teacher. And while we had a lot of love growing up, money was not necessarily easily and readily accessible all the time. And in fact, we only went out to dinner when I got straight A's on my report card. So I remember very vividly when I was about 6 years old, running home from school and coming into the kitchen and telling my father, Daddy, 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 we need to go to Pizza Hut tonight for dinner because I got all straight A's on my report card. And my loving father sits back and folds his arms and says to me, Carolyn, you need to eat dinner tonight. You want it to be pizza and you wish it were Pizza Hut. And so I offer you that friendly story around needs, wants, and wishes as encouragement to be gentle with yourself and thoughtful around how you can stay on track with your own finances. Yes, it may be possible to meet all of your needs, wants, and wishes around your wealth, but it may not necessarily make sense to do it all today in this moment. There may be more strategic ways to do it over time, so that through prioritization, that's what makes it possible. And lastly, part of staying on track, one of the most common elements of what this looks like might be inconsistent or inadequate savings and investing across different accounts. And we'll go into this further in a subsequent part of our series. But the key takeaway I want you to realize in this moment is that as part of staying on track, a complete financial picture includes everything from emergency savings today to mitigate financial setbacks, like we talked about. It includes tax-deferred savings and investing. Think of things like retirement plans, health savings accounts, 529 plans, and also investment accounts. And it's across those different types of savings and investing that you are best setting yourself up for success so that you can move beyond today's budget and experience joy and staying on track into our 90s, as we anticipate we will. And so as we try to manage these mistakes, as we try to think beyond the short term, as we try to juggle those priorities and remember that story I offer you, and as we try to introduce regular savings and regular investing, what is the strategy for doing it? What is the technique for doing it? It has to do with creating a financial plan. And we'll talk a little bit more about this and a lot more about it in next week's session. But this is the key helpful strategy for staying on track. The last area of common money mistakes is potentially something that's a little harder to do for many people. And it has to do with making decisions. Remember that fourth component of financial well-being, the enjoyment of our wealth, the idea that we have financial freedom? How do we get to that level of delight, dare I say, when it comes to our money? We get there when the foundational pieces are met. When we know how we're managing finances through our budget, when we understand our balance sheet and how we can manage those disruptions and those shocks, when we have a vision for our goals and staying on track through our plan, and when we make decisions along the way involving both people whom we love, as well as trusted, experienced professionals to give us advice. So what does a mistake around making decisions look like? An example may be just avoiding money talks altogether. So there are many, many families where there might be a division of roles and responsibilities, either specifically articulated or understood. One partner might be in charge of the grocery list, of the monthly spend, of the paying off the credit card bills, and the other partner thinks about the investments, talks with a financial advisor. Both activities are covered because different partners do things, but the partners aren't necessarily talking with each other around how it's going, where the risks are, how it might be able to be improved. So this first element is, it's great that your money is being managed, but you need to be talking about the management, understanding the who is doing what and how it's working, so that you both are informed and aware. If something should happen to one of you, the other one is covered. And let's say you are an independent individual, understanding all of these components. Even if that's the case, it may be helpful and important to have a money talk with a trusted fiduciary financial professional who works in finance, with a CPA or an accountant, or with a trust and estate attorney to make sure your estate plans are all structured the way that you wish. Key thing here is, a mistake that happens is people do that proverbial head in the sand. I don't want to talk about it, I'll just do it. But you need to talk about it to understand what's happening, why it's happening, and how you can continuously improve it. Second area of making decisions that's a common mistake is having outdated or incomplete beneficiary designation or estate plans. Whenever you work for an employer and open up a 401k or a 403b, or let's say you are a self-employed professional or a business owner and you open up a traditional IRA or a SEP IRA or a solo 401k or a Roth IRA, you are required to identify the individual who, upon your passing, comes into ownership of that asset or that investment. And many times in life, whether it's divorce or death or changing your mind, the individual that you first identify, say in your 20s when you first worked for that employer and first opened that plan, that may change by the time you're in your 30s or 40s or 50s. Or maybe as you're first starting out as an independent professional, you may not have things set up like a will, a healthcare proxy, or a power of attorney. But what's essential is, as your life continues to develop and progress, that you talk with a trust and estate attorney and have in place the legal structures so that when things may not happen or may happen not according to plan, like you lose your mental faculties or you have other kind of health conditions requiring you to authorize someone else to make decisions on your behalf, you have the infrastructure to make that happen seamlessly. The last way that this might manifest itself in terms of making decisions and it being a mistake, maybe delaying important decisions. It's just like anything in life, procrastinating, or, oh, we'll refresh that will later, or, oh, I'll update those beneficiaries next week. We all have heard these stories that are very true, whereby somebody knows she needs to update her estate plans, and all of a sudden she loses her life partner. And now she's not only grieving with the loss of her life partner, but now she's on the scavenger hunt of her life, trying to figure out what her partner was doing on her behalf with the finances. And she's trying to find what's happening with the estate plans. Delay is not serving you. Attention today is. So how do we manage making decisions, that delay of decisions, the intentional conversations around money? We strategically engage trusted partners. We tell the people who are important to us, who are part of our financial day-to-day decisions, who might be beneficiaries of our accounts. Professionals like a trust and estate attorney, a CPA or accountant, or a fiduciary financial professional to work with us, to help us prioritize, to help us have those tough conversations so that we are making thoughtful decisions, building up our financial choices over time. As we then move from making the common money mistakes and identifying the strategies to action, I want to highlight a key thing, that when it comes to personal financial planning, the whole title of this bootcamp is personal financial planning. The key thing for you to keep in mind is it's a continuous prioritization. Personal financial planning for you will look very different than personal financial planning for your cousin or your best friend or someone else. The key thing that we're talking about here is, in light of these money mistakes that we're trying to mitigate, in light of this financial well-being, we're striving to create. What we're seeking to do through this boot camp, through these strategies, is to give you a foundation for those prioritizations around what you need to do today and over time to set yourself up for financial success. And it will look different. It might be as intentional and deliberate first as creating the budget. That may be your most important priority. If you already have clarity around your cash flows, it may be instead looking at the balance sheet and how your assets and liabilities work together and how you can be even more effective and efficient. Maybe it's taking it to the next level where it's saying, okay, what are our larger needs, wants, and wishes independently or as a family? And how will we coordinate things like our investments and our insurance to make it happen? Or who are the trusted partners we will engage in the process? The main thing I want to emphasize here is, as you move forward and as we talk about these strategies, in the same way we broadened our explanation of financial health and well-being to be around those 4 dimensions, retain as well the broad flexibility and understanding that personal financial planning is a process, is a set of priorities that are continuously evolving, emerging, and changing in light of your life experience. So if that's the case, as we begin to prepare to wrap up together, how can you assess your current level of financial health? What are some helpful tools and resources and numbers to keep in mind? Here's the first of 2 sets of information I'd love to offer you. The first has to do with online tools that are directly related to those strategies I mentioned earlier. Through this website, consumer.gov, you can access an online budget sheet. It is easy, it's straightforward, and super manageable. In 2 pages that you can play around with in the comfort of your own home on your own computer, you can break down income and expenses month by month. If your initial priority, if your initial goal in terms of managing money mistakes is all about budget, this is a tool that can help you do it. If we're thinking about those common money mistakes and developing a balance sheet, an organization called SCORE, which is a great organization in our community that provides a lot of different tools, primarily for business owners, to help them make thoughtful business financial decisions. They offer through their website a personal financial statement. It's an Excel-based document that, again, comfort of your own home at any time of the day, you can download and type in. What are the things that you own? What are the things that you owe? And it provides a framework to begin to put these pieces together. Now, let's say you might already have that clarity of the budget, the comfort in what you own in the balance sheet, but you know that it's more of that next level of planning and conversation and trusted advisor making decisions. Here is an interesting resource as well that you can utilize to tap into further how financial healthy you are. It's through the Consumer Finance Protection Bureau, the same organization that created those 4 pillars of financial well-being. And if you go to this website, they have a very simple 10-question quiz that you take that offers questions around how you make decisions today and how comfortable you are with things, and provide constructive feedback around how you might be able to up those numbers or increase that level of financial health and wellness. And here is an interesting point. I've encouraged other people to look at this website and take this quiz. And they volunteered to me that at different points in time when they take this quiz, they get different levels of financial health and well-being, which makes sense, right? Because at different points in our life, we may have different levels of clarity, comfort, and confidence with regard to what we're doing. To complement these online tools that are available to you, here are some questions and a couple more numbers again that I recommend you keep in mind. First, for whom am I financially responsible today? And how will this change over time? That will drive a lot of our budgeting decisions, a lot of our balance sheet decisions, a lot of our financial planning decisions. If we're parents, that we will have children that we're responsible for today, maybe until they graduate high school. Maybe that will look different for a few years after high school. Maybe you have different expectations around once they go to college. For many people who are in the sandwich generation with both aging parents as well as aging siblings and as well as children or nieces and nephews, different loved ones may be important to your financial spend at different life stages. But understanding who are they, what are the expectations that I have of them and for them, and when and how will this change? What are my sources of income and when will this change and how much? And here's another interesting number just in your back pocket. These are general numbers that will vary person to person. But in general, if you're accustomed to a certain level of income during your working years, what you're striving to do is build up savings and investing to supplement, in general, around 74% of that income once you're in retirement. And we'll talk more about that in a future session. Third question, remember this, as I mentioned earlier, what are my needs, wants, and wishes? And how am I growing and using those different type of accounts? Emergency reserves, 3 to 6 months, tax favored accounts, retirement, flexible spending, health spending, college funding, and investment accounts. How am I using each of them to best set up my choices? What are the policies and plans to protect my wishes? Whether it's the investment strategy within and across all my accounts, insurance decisions and the estate plans and trusts where they're applicable. And lastly, who are the people that I trust? And I often cite the trifecta: your fiduciary financial professional, your CPA or tax preparer, and your trust or estate attorney, who collectively as a team can provide you inputs. And as we begin then to be summarized together, because I acknowledge our time together is wrapping up, what are our key takeaways from this first of the 4-part series of our financial bootcamp? Together, we have defined financial well-being. We also have reviewed those common money mistakes and strategies for preventing them. And I've shared with you both online resources as well as some questions to consider and numbers along the way so that you can assess your current level of financial health and build it over time. I would invite you to join Celeste and me and Ives Squared in New Haven Public Library again next week, where we will enhance this information with additional focus on building your financial fitness plan. And as you can see, we have future sessions, like I mentioned earlier, about investing as well as retirement planning. And at any time, I am delighted to provide you a complimentary consultation, as well as I'd invite you to share feedback to today's session. Celeste and I, we have a survey you're more than welcome to complete. Help us help you and provide you additional information. So with that, I'd love to say thank you again for this opportunity to share this information with you and hand it back over to Celeste for closing.
Thank you so much, Caroline. And I want to thank you and thank you everyone for joining us today. This was amazing. I mean, it's like I'm here taking notes also for myself. And this session, I want to say, is being recorded. So for the ones that enjoy, if you think they're like very important points, please share with your family and friends. It will be in YouTube later on, and it's in Facebook already. And I can wait until end of this month for the second session and go from there. So thank you so much.
Thank you.
All right. Bye, everyone.